Hello everyone, this is Jennifer. So moving on to the next part of the cash flow statement. So from the following balance sheet of XYZ Company Limited, make cash flow statement. Have your liabilities and you have your asset side which is given. So liabilities, equity share capital, it has increased, so you will add it in your financing activity. Share premium has increased, so you will add it in your financing activity. Retained earnings, last year it is 23,820, the current year it is 30,820. So if you see, there is no profit and loss balance given, so hence we will consider the retained earnings balance as the net profit. So 30,820 minus 23,820, so which the amount will be 7,000. So that is nothing but your net profit. So next we have a mortgage loan. So mortgage loan has increased from zero balance to 20,000, which means to say mortgage loan has been raised by the company. Since there is inflow of cash, you will add it in your financing activity. Creditor is basically a current liability. So current liability, when current liability decreases, you will minus it. So if you see 6,900 last year, the current year it is 6,000, so it has decreased, so you will minus it. Next is provision for taxation. Last year it is 1,000, the current year it is 1,400. Provision for taxation will prepare a ledger account. Outstanding salary is again a current liability. So last year it is 2,000, the current year it is 1,400. It has decreased, hence you will minus it. Plant and machinery, you will prepare a ledger account. Accumulated depreciation, you will prepare a ledger account. Building, you will prepare a ledger account. Accumulated depreciation on building, you will prepare a ledger account. Land, so if you see, there are no adjustments on land given, so hence we will not prepare a ledger account. If you see, it is an increase, so which means to tell land has been purchased. If it is purchases, it will be minus because the cash is moving out of the business in your investment activity. So 12,000 minus 10,000, 2,000 will be minused in your investment activity. Stock is a current asset, so when current asset increases, you will minus it. When current asset decreases, you will add it. So it has decreased, so you will add it. Debtors has also decreased, so you will add it. Prepaid expenses has increase, so you will minus it. And cash balance, you will take it as opening and closing balance in your cash flow statement. Moving on to the adjustments. Plant costing rupees 16,000, accumulated depreciation of rupees 14,800 was sold for the year at rupees 12,000. So the plant costing 16,000 has an accumulated depreciation of 14,800. So 16,000 minus 14,800, balance is 1,200. The written down value of the asset is 1,200, but it was sold for 12,000, which means to tell it is sold on a profit. So what is your profit? 1,200 minus 12,000, which is 10,800, is nothing but your profit on sale of plant. The second question, second adjustment, building was acquired during the year at a cost of rupees 21,000. In addition to cash payment rupees 1,000 and 7% mortgage loan was raised. So this 21,000 was paid by issuing mortgage loan of 20,000 and 1,000, which is cash payment. So that will be shown in your ledger account of building. Next is dividend of rupees 8,000 was paid during the year, so which will basically be added in your net profit and minus in your financing activity because it is outflow of cash. Next is a sum of rupees 13,900 was transferred to profit and provision for taxation account in the year 2009. So which means if it's a transfer to profit and loss account for the current year, it will be by profit and loss account, which will be credited in your provision for taxation ledger account, which is 13,900, and it will also be shown in your added in your net profit in order to calculate the cash net profit before taxation. So let's move on to the solution part of it. So first is your plant and machinery account. Starting out with the ledger account, we are supposed to prepare the ledger accounts for our fixed assets, which is plant and machinery. So plant and machinery is an asset account, so you'll have a debit balance. The opening balance is 62,000 and the closing balance is 66,000. So to balance brought down 62, by balance carried down 66. So if you see, there is an adjustment which tells plant costing rupees 60,000. Accumulated depreciation is how much? 14,800. So by accumulated depreciation 14,800 was sold for the year at 12,000. So by bank account, because cash is coming in when you have a sale, so by bank account 12,000. So what is the profit that you're getting? 16,000 minus 14,800, so which you get 12,000. So 12,000 worth of plant was sold for 1,200 worth of plant was sold for 12,000. So which means to tell it's a profit on sales. So to profit and loss account, 12,000 plus 14,800 minus 16,000, which is 10,800. So that is all is the adjustment. So if you see, there is a credit balance, so hence the balancing figure to bank account, which we consider it as purchases, and we will take it in our cash flow statement. This 20,000, which is nothing but the balancing figure in your plant and machinery account. Moving on to the next account, which is buildings account. So buildings account is also an asset account. So opening balance is 95,000, closing balance is 1,16,000. So to balance brought down 19,000, which is a debit balance. By balance carried down 1,16,000. Now if you see, any other adjustment is given on buildings account. There is adjustment which is given: building was acquired during the year at a cost of rupees 21,000. In addition to cash payment of rupees 1,000, and 7% mortgage loan was raised. So to bank account, which is 21,000, which is nothing but your purchases. So if you balance it, you're getting the balance. So there is no balancing figure. Now moving on to your accumulated depreciation account on plant. So what is your opening balance? Opening balance is 37,000 and closing balance is 26,200. So by balance brought down, it is 37,000, and to balance carried down, which is 26,200. So if you see, there is accumulated depreciation which is charged in your plant and machinery. Just the correspondent entry you will put it here. So to plant and machinery account, 14,800. So the balancing figure will be transferred to your profit and loss account, so which is 4,000. So moving on to your accumulated depreciation on buildings account. So what is your balance? 43,000 and 45,000. So by balance brought down 43,000, to balance carried on 45,000. So by profit and loss account, which is a balancing figure, 2,000. So now moving on to your provision for taxation account. So provision for taxation account, in this question we consider it to be a non-current liability. So if we consider it to be a non-current liability, we will be preparing our ledger accounts. So opening balance is 1,000 and closing balance is 1,400. So by balance brought down 1,000 and to balance carried down 1,400. So if you see, there is an adjustment which tells a sum of rupees 13,900 was transferred to provision for taxation. So it is a current year provision, so it is by profit and loss account. 13,900. So your balancing figure is which we consider to be tax paid, which is to bank account. If it is to bank account in provision for taxation, we consider it to be tax paid. If it is by bank account, if you have a debit balance, then we consider it to be profit and loss account. Here it is a credit balance, so it is to bank account, which consider it to be tax paid, which is 13,500. So your ledger account gets tallied. Now let us move on to the cash flow statement. So if you start with the cash flow statement, we start with cash from operating activity. So your net profit, here we don't have a net profit, the retained earnings, which is 30,820 minus 23,820, which we consider to be the net profit balance. So you get 7,000. Add your dividend paid, which is given in your adjustment, 8,000. Then your provision for taxation, which is your current year provision, which we have it from our provision for taxation ledger account. So your net profit before taxation will be 28,900. So now adjustment for non-cash and non-operating items. So you add all the non-operating expenses and you minus all the non-cash and non-operating incomes. So in the question we have only the depreciation which is given. So depreciation on plant and machinery, which is 4,000, which is nothing but the balancing figure from your accumulated depreciation account. I again repeat, it is a balancing figure from accumulated depreciation account, which we consider it as depreciation for the current year. So depreciation on plant and machinery, it is 4,000. Depreciation on building, it is 2,000. Minus your non-cash non-operating income, there is a profit on sale of plant and machinery, which is 10,800. So if you add 6,000 and minus 10,800, which you get 24,100, which is nothing but our net profit before working capital changes. Now we will add the increase in current liability and decrease in current assets. So if current liability decreases, if current liability increases and the current asset decreases, you will add it. So decrease in stock is 600 and decrease in debtors is 1,000. So minus your decrease in current liability and increase in current assets. So decrease in creditors we have 900, decrease in outstanding salaries we have 600, and increase in prepaid expenses we have 80. So we get a balance to be 1,600. If you add, you get 27,000, 25,700, and if you minus 1,580, you get 24,120, which is nothing but our net profit, net operating profit. Now if you minus the income tax paid, which is 13,500, we get the net cash from operating activity. So this is your first part of the solution, which is your net cash from operating activity. Now let us move on to the cash from investing activity. So if you have any sales of your long-term assets or a fixed asset, you will add it. If you have any purchases, you will minus it. So from your ledger account, we came to know whatever to bank. If it is to bank, it is purchases. If it is by bank, it is sales. So if you have sales, you will add it. So sale of plant and machinery 12,000, you will add it. Purchase of plant and machinery minus 20,000 because you are going to minus it. Purchase of building minus 21,000 and purchase of land minus 22,000. So you get your balance, which is net cash from investing activity, which is a negative figure of minus 31,000. So cash from financing activity, which is now you will add whatever has increased your share capital or whenever there is an inflow of cash, and you will minus whenever there is outflow of cash with regard to financing activity. So if you see in the question, we have your share capital and the share premium which has increased, which we assume the cash is coming into the business. So you add your issue of share capital, which is 10,000, share premium is 2,000, and issue of mortgage loan, which is raised by the company from a nil figure to 20,000 in order to purchase or pay the purchases of building, minus your dividend paid, which is given in your adjustment, which is minus 8,000. So you get your balance, which is 24,000, is a net cash used from financing activity. So your net increase or decrease in cash and cash equivalent is equal to, you add the balance of all the three activity, which is 10,600 minus 31,000 and plus 24,000, so which you get the balance to be 3,620. So when you add your opening balance, now what is your opening balance of cash? 6,180. So if you add 6,180, you should get the cash and cash equivalents at the end of the year, which is your closing balance, 9,800. So if you check the question, it is 9,800. So your solution is right and it is correct. So moving on to the next question. From the following balance sheet, compute the cash flow statement under the indirect method. Have your liabilities side and you have your asset side given. So if you see, there is a trick in this question wherein they have given the first column to be your current year and the second column is your previous years. So the first column is for 2005 and the second column is for 2004. So if you see, you're comparing 2004 with 2005. So compare it as however we do it. So creditors, if you see, last year it is 37,000, the current year it is 32,500. It has decreased, so you will minus it. Wages payable also has decreased, it's a current liability, so you will minus it. IT payable, so IT payable, which is your provision for taxation, so you will prepare a ledger account for this. Mortgage payable, so last year it was 1 lakh, this year it is nil figure, so which means to tell we have paid our mortgage loan. Equity share capital as, sorry, last year it is nil figure and the current year it is 1 lakh, which means to tell it has increased. So which means to tell we have raised mortgage loan. Equity share capital, last year it is 3,50,000, the current year it is 4 lakh, which means to tell issue of equity shares. You will add it in your financing activity. Securities premium, last year it is 45,000, the current year it is 55,000, it has increased, so you will add it in your financing activity. Profit and loss appropriation account, you will have the 1,19,100 minus 1,54,100, which you get a balance of 35,000, which is nothing but our net profit. So now moving on to the asset side, they have given the cash balance, they have given debtors. So debtors as decrease, so if it's a decrease in debtors, you will add it. 45,000 minus 41,000, the amount is 4,000 is a decrease, you will add it. Inventories is a current asset, so inventories also decreased, so you will add it. Prepaid expenses has increased, so you will minus it. If it's an increase in prepaid expenses, you will minus it. Machinery account, you will prepare a ledger account. Accumulated depreciation on machinery, also you will have a ledger account. Buildings, you will prepare a ledger account. Accumulated depreciation on buildings, also you will prepare a ledger account. Land, if you see, last year it is 50,000, the current year it is 60,000, which means to tell it has increased. So it is purchase of land. If it is purchase of land, what you will basically do, minus it, because the cash is moving out. So moving on to additional information, dividend of rupees 40,000 were declared during the year. So you will add it in your net profit and you will minus it in your financing activity. Machinery with an original cost of rupees 80,000, accumulated depreciation of rupees 74,000 was sold during the year for rupees 6,000 cash. New machinery was also purchased, so which means to tell 80,000 is the cost of the machinery and accumulated depreciation is 74,000. 80,000 minus 74,000, 6,000 is the worth of machinery and it was sold for 6,000, which means to tell there is no profit nor loss. And new machinery was purchased, which you will show it in your machinery account, ledger account. Land and buildings were acquired during the year at a cost of 1,15,000, addition to the down payment of rupees 15,000. A 10-year 10% mortgage note of rupees 1 lakh were issued to the vendor. So land and building were acquired for 1,15,000. This 1,15,000 were paid on the basis of cash, which is 15,000, and the remaining through mortgage loan. So now they have given the income statement also. So if you see the income statement, we have our sales, we have our cost of goods sold, gross profit on sale, operating expenses, depreciation on machinery 20,000 and depreciation on building 10,000. This will be taken in your non-operating expenses. Other operating expenses, they have given income from before tax and income tax paid, which is 16,900. so this will be minus in your income tax paid after your non-operating profit. So this is your income tax paid for the year. So moving on to the solution part of it, so we have our ledger accounts. First is our machinery account. Machinery account, so you have your opening balance and you have your closing balance. So machinery account 3,30,000 and 3,10,000. So two balance brought down, since it is an asset account, it is a debit balance 3,10,000. By balance carried down 3,30,000. Now if you see, there is an adjustment which is given, which tells machinery with an original cost of ₹80,000 and accumulated depreciation. So by accumulated depreciation 74,000 was sold for the year, during the year 6,000. So by bank account 6,000. New machinery were also purchased for ₹1 lakh. So to bank account 1 lakh. So if you see, when there is a sales happened here, there is no profit and loss accounts. You're not updating any profit and loss account, and it gets balanced. So it's 4 lakh and 10,000. So moving on to your next account, which is buildings account. So your opening balance of buildings is 5,80,000 and opening balance is 4,75,000 and closing balance is 5,80,000. So two balance brought down 4,75,000. By balance carried down 5,80,000. And in the adjustment, they have given land and building were acquired during the year at a cost of 1,15,000. So and which was paid with the help of bank and mortgage loan. So to bank account 15,000, to mortgage loan account 1 lakh, and your balancing figure is 10,000. It is by bank account, which you consider to be sales in your cash flow statement. Accumulated depreciation account on plant. So opening balance is 1,85,000, closing balance is 1,31,000. So by balance brought down 1,85,000, to balance carried down 1,31,000. If you see, there's an accumulated depreciation of 74,000, which is your corresponding entry in your accumulated depreciation account as to machinery account 74,000. So your balancing figure is by profit and loss account 20,000. Either it is your balancing figure or you can take it from your income statement for the last year, which is 20,000. So it get balanced. And moving on to your accumulated depreciation on building. So by balance brought down 2,15,000, to balance carried down 2,25,000, and by profit and loss account, your profit and your depreciation on building is 10,000. So by profit and loss account 10,000, or it can also be considered as your balancing figure. Moving on to your next account, provision for taxation. So by balance brought down, which is 5,000, and your IT payable, by balance brought down 5,000, to balance carried down 7,000. So by balance brought down 5,000, to balance carried down 7,000. So if you see in your income statement, income tax, which is 69,500, can be accounted here as to bank account tax paid, which is 67,500. By profit and loss account, which is your provision, which is So income tax 69,500 is your provision for income tax. It is by profit and loss account provision 69,500 to bank account, which is your tax paid, which is a balancing figure 67,500. Moving on to your cash flow statement, cash from operating activity, net profit, which is your profit and loss appropriation balance, which is 1,19,100 and 1,54,100. So 1,54,100 minus 1,19,100, which you get 35,000. So you add your proposed dividend 40,000 in your provision for taxation from your income statement, which is 69,500. You get a balance of 1,09,500. So net profit before taxation is 1,44,500. Now you take consideration of the adjustment for non-cash and non-operating items. So if there's a non-cash and non-operating expenses, you add it. If it's a non-cash and non-operating incomes, you minus it. So under that we have the depreciation on plant and machinery and building, which is 20,000 and 10,000 respectively, which is from your income statement or the balancing figure from the ledger accounts, which is 30,000. So if you add it, you get 1,74,500 minus your non-cash non-operating income. We don't have anything, so it's a nil figure. So your operating profit before working capital changes is 1,74,500. Now we will add our increase in current liability and decrease in current asset. So decrease in stock 3,000, decrease in debtors 4,000 will be added, which you get 7,000. The total is 1,81,500 minus a decrease in current liability and increase in current asset. So a decrease in creditors 4,500, decrease in wages payable 3,000, increase in prepaid expenses because it's a current asset 400. So you'll get minus 7,900. Since it's we will minus it, we are putting it in minus sign. So 1,81,500 minus 7,900, which you get 1,73,600. So now you'll minus your income tax paid, which is a 67,500, which is your balancing figure from your income tax payable ledger account. So your net cash from operating activities 1,06,100. So moving on to your next activity, which is cash from investing activity. If it's a sale, you will add it. If it's a purchases, you will minus it. So sale from plant and machinery 6,000, sale from building 10,000, you will add it. The purchase of plant and machinery, which is 1 lakh, minus it. Down payment paid on purchases of machinery, which is in your adjustment. You see your adjustment, land and building were acquired during the year at a cost of 1 lakh in addition to the down payment of rupees 15,000. So you'll minus that down payment of paid on purchases of building minus your purchase of land 10,000. So you get the balance as 1,09,000. So which is nothing but your net cash from investing activities. Moving on to your third type of activity, which is cash from financing activity. If there is inflow of cash which relate to financing activity, you will add it. If there is outflow of cash, you will minus it. So issue of share capital is 15,000, you will add it. Share premium has increased, which is 10,000, you will add it. Minus your dividend paid, which is outflow of cash, which is minus 40,000, you will minus it. So your net cash used from financing activity is 20,000. So net increase in cash and cash equivalents is 1,06,100 minus 1,09,000 and plus 20,000, which you get 17,100. So what is your opening balance of cash and cash equivalents? So opening balance of cash and cash equivalents is, opening balance is 28,900. So if you add the 28,900, you should get the balance of 46,000, which should be equal to your closing balance, which is 46,000. Hence your answer is correct. Moving on to your next type of question, which is from the following balance sheet, compute the cash flow statement. So our next question, from the following balance sheet, compute cash flow statement. It is a Success Limited balance sheet which is given. First they have given the current year, next they have given the previous year. So your share capital, it is 1,000 the last year, the current year it is 1,500. Last year it is 1,000, the current year it is 1,500. It has increased, so you will add it in your issue of share capital and financing activity. Reserves and surplus, last year it is 550, this year it is 775, so it has increased, so you'll add it. Long term loans, last year it is 1000, the current year it is 1300, again it has increased, you will add it in your financing activity. Sundry creditors is a current liability, it has increased, so you will add it. Interest payable is a current liability, it has increased, so you will add it. Income tax payable, you will prepare ledger account. Proposed dividend, if you see the last year 200, the proposed dividend is nothing but the current year dividend paid. Okay, so this 200 will be minus from your financing activity, and the current year proposed dividend will be added in your net profit in order to get your net profit before tax. Assets, fixed asset, you prepare a ledger account. Under your asset side you have a fixed asset wherein you prepare a ledger account, and you have accumulated depreciation, again you prepare a ledger account. So your asset and your accumulated depreciation, you prepare a ledger account which is under your asset side. Next you have your long-term investment which has increased, which has decreased from the last year. Last year it is 50, last year it is 500, and the current year it is 750, so which has increased, so you will minus it from your investment activity because it is a long-term investment. And your short-term investment is a current asset, so it has increased, so you will minus it. Inventories is your current asset, it has increased, you will minus it. Sundry debtors is a current asset, it has increased, so you will minus it. Interest receivable is a current asset, it has increased, so you will minus it. Cash and bank balances, you will show it as opening and closing balance is your cash flow statement. So moving on to your profit and loss account for the year ended 31/3/2000 and year 7. So if you see there's profit and loss account given, so in this what we consider is only the dividend, which is nothing but which comes under your income, so it is dividend receipt. So if it is dividend receipt, what you will do, it is a financing activity, so you will add it because it is dividend receipt, it comes under your income. And your interest and depreciation, you will show it as non-cash or non-operating expenses. Your provision for income tax will be considered, and your proposed dividend will be considered. And you have your repayment of term loan amounted to rupees 100 lakhs. So this 100 lakhs we have on our term loan, so you will prepare your ledger account. Amount realized on disposal of old fixed assets rupees 200 lakhs. So there is disposal of old fixed asset at rupees 200 lakhs, but the book value also is rupees 200 lakhs. So do you think any profit or loss is there? So there is no profit and loss. So moving on to our ledger accounts. So first we have our fixed assets. So to balance brought down 2400, by balance carried down 3000. So your in the adjustment they tell your fixed asset disposed at rupees 200 lakhs. So which means to tell by bank account 200 lakhs, and accumulated depreciation is 140. So before this, if you prepare your accumulated depreciation account, so by balance brought down 900, to balance carried down 1000. So your current year depreciation, which is given in your profit and loss account, which is 240. So your balancing figure is how much? 140, which is nothing but two fixed assets account. So that corresponding entry will come here as by accumulated depreciation account, which is 140. Next we have our long-term loans payable account. So by balance brought down 1000, to balance carried down 1300. So it will have a credit balance. So now if you see your adjustment, it tells repayment of term loan amounted to 100 lakhs. So to bank account, cash is moving out, which is 100 lakh, and by bank account long-term loans paid raised, which is 400 lakhs, which you get from your balance sheet, which is the balancing figure of long-term loans. So if you see your long-term loans, last year it is 1000, the current year it is 1300. which we are showing it as balances. This bank account is nothing but your balancing figure. So since it is by bank account, we consider it as by long-term loans raised. So your balance is 1,400 and 1,400. Moving on to your next account, which is provision for taxation. By balance brought down, which is 100, and to balance carried down 150. So now if you see by profit and loss account, which is our provision for the year, which is shown in our profit and loss account in the question, which is 300. So the balancing figure is to bank account, which is 250, which we consider it as tax paid. So moving on to your cash flow statement. So cash flow statement, cash from operating activity, net profit. So we don't have a profit and loss account balance, but they have given the balance of reserves and surplus, which is 775 minus 550, which is 225 as our net profit. Add your proposed dividend 300, your provision for taxation 300, which you get 600. So your net profit before taxation is 825. Adjustment for non-cash and non-operating items. So you have your depreciation and interest from your profit and loss account, which is 240 and 200. So you get 440. Your total is 1,265. So your non-cash and non-operating income is dividend received and your interest received. So 50 and 75, which you get minus 125. So if you minus it, you get 1,140. So interest received, if you see this dividend and interest received, where did we get this? If that was a question, so if you see your profit and loss account of in your question, they have given under your income side interest 75, dividends 50. That is what we consider to be other non-cash or non-operating incomes. So you get your operating profit before working capital changes as 1,140. So your increase in current liability and decrease in current asset will be added. So increase in creditors 150, increase in interest payable 25. So you get 175 minus your decrease in current liability and increase in current asset. So increase in inventories 200, increase in debtors 350, increase in interest receivable 25, increase in short-term investment 25. So you get minus 600. So if you minus it, you get a balance of 1,140 plus 175 minus 600, you get 750, which is net operating profit minus your income tax paid for the current year, so which is 250. So you get your net cash from operating activity as 465. Now moving on to your, so if there is a sale happening, you will add it. If there is a purchase happening, you will minus it. Sale of fixed asset is 200, purchase of fixed asset minus 940, purchase of long-term investment minus 250. You get the balance as net cash from investment activity, which is minus 900. So now cash from financing activity. So issue of share capital 500 because share capital balance has increased. Long-term loans raised because long-term loan balance has increased 400. So minus your long-term loan paid from your ledger account minus 100. Minus dividend for the year 2006 paid minus 200. Dividend received and interest received from your profit and loss account, which is 50 and 75 respectively. And interest paid is minus 200, which you get it from expenditure under your profit and loss account. So net cash used from financing activity is 525. So if it is a positive figure, it is net cash from financing activity. The negative figure, it will be net cash used in financing activity. So we have a positive figure here, so it is net cash from financing activity. So net increase or decrease in cash and cash equivalents, you add all the three, which is 465 minus 990 and 525, you get a nil figure. So if you add your opening balance of cash and cash equivalents, which is, what is your cash and cash equivalents opening balance? So if you see your cash and cash equivalent opening balance is 25 and the closing balance is 25. So if you add your opening balance, you should get your closing balance. So 25, when you're getting your 25 as your closing balance, which is equal to cash and cash equivalents at the end of the year. So the answer is right and correct. So hope the question and answer was clear. So always your opening cash balance plus your net increase in cash equivalents should be equal to your closing cash and cash equivalent balance at the year. So this is your cash flow statement. Thank you everyone.